So welcome to my new series on credit myths. If you do have any credit questions, please feel free to leave a comment and your question may be selected for a future video. Today's topic is myth number 1, revolving utilization. These are something that I hear quite often from clients. They're very confused why they feel like they're managing their credit responsibly, but their credit score is just plain awful. So the myth goes something like this. To maximize your score, you should use your credit card every month, then pay the balance in full when you get the statement. So let's look at two different borrowers here that are both managing their credit very differently. Borrower 1 has 2 credit cards, each with a $1,000 limit. They spend $950 a month on each card, and they pay those balances in full every month. So they're using their credit responsibly because they're never accruing interest charges. They can always pay their balance. They're not charging more than what they can afford to pay off that month. Let's compare them to borrower 2. Borrower 2 has 5 credit cards with small balances, about $300 each. They've stopped using the cards entirely because they've realized that they started racking them up to the point where they couldn't pay them off every month. And they're just now making the minimum payment each month. So those balances aren't really going anywhere. Well, borrower 1 in this example has a 590 credit score. Borrower 2, a 710. That's a huge difference if you're trying to go out and maybe buy a new home or buy a car or anything else where your credit is going to come into play. Keep in mind that having that low credit score isn't necessarily a bad thing. It's really only harmful to you when you need to borrow money. So if borrower 1 doesn't need to borrow money for anything anytime soon, there's really no long-term damage to their credit. Let's talk about some of the facts that go into credit scoring here and why that myth seems to be so prevalent. So the amounts you owe on credit make up approximately 30% of your credit score. Now there's different algorithms for credit scoring, but that's a good general rule. Well, the amount that reports to the credit bureau each month is your statement balance. It's not your balance after you've made your payment. So in order to maximize your credit score, you really want that statement balance to be less than 10% of the limit per account and then also in total. If you have high total credit utilization or any individual account, that can severely hurt your credit score. So in this circumstance, really what it looks like to a lender is it looks like borrower 1 has credit cards that are maxed out and can't pay their bills. It looks like borrower 2 is managing their credit fairly responsibly with those roughly 30% limits. So 30% is not bad either. Really 10% or less is ideal. So if I had this situation with a client, which I run into quite often, we're trying to coach them to get their score up so that way they can get the lowest rate possible on their mortgage. What I would recommend for borrower 1 is next month, just charge $100. So after they pay that statement in full like they're used to doing, just charge $100 on each card, use cash for all other purchases, and really less than $100. Once those new balances report, that score will dramatically increase. After that happens, they can go and request credit limit increases from their additional lenders or their additional credit card holders, or they can go out and open some additional cards as well. So they have a few more than just the 2. 2 is not really bad, but I would say you probably want more than that. And then moving forward, never charge more than 10% of the limit again. So that way they know every month when their statement balance reports that they're going to have less than 10% credit utilization. Or if they have to, maybe up to 30% or so, but I really wouldn't go higher than that unless you need to. Now for borrower 2, what they should be doing is they should budget as much as possible and pay as much as they can on the card that has the highest interest rate. Once that card's paid off, they can move on to the next highest rate and then move on to the third card. Once they get their balances down to under 10%, their credit score is going to come up quite a bit as well. And they should continue using that credit conservatively, never charging more than about 10% of their total limits. And again, that means per card as well as in total. Now, the easiest way to monitor this for you is to sign up for any one of the many free credit monitoring services. I won't name drop any of them, but you shouldn't be paying for credit monitoring. Most banks are offering this for free nowadays, and there's also other ways to get it for free as well. So if you have questions and you're not sure where, feel free to reach out to me directly, but those services are pretty widely available nowadays at absolutely no cost. And if you are managing your credit and you're trying to figure out when things are reporting, usually within a few days of that statement coming out from your creditor, that's when it's going to hit the actual bureau. So if you're ever watching for that, usually somewhere 3 to 5 days after your statement gets reported, that's when you're going to see that change in your credit score. So hopefully this was helpful. If you have any comments, questions, anything like that, leave them below and I will be happy to address those.